Well, there's different amounts of money needed in each stage, and it's a really big range, right? So seed capital is typically in the range of nothing. I've seen plenty of companies that started with nothing, or a few $1,000s, or maybe even $200,000. Right? I've seen friends and family pools that have been that big. Then that startup phase, again, it's a huge range. It's, it could be $50,000, it could be 25 in Africa, but more typically it would be 100,000 to really $2 million. There's a company I'll talk about in here. They raised $2 million before they had anything, before they had a customer. And then we get to the early growth, and again we have this giant range, and now it can get even bigger, and then it gets bigger and bigger and bigger. And these aren't the VC numbers, right? If we went down one line to what VCs would invest, we would be adding some more, 5 or 10 or 20 times to this number. How do you structure this capital that goes out to these entrepreneurs? That's what we're going to talk about mostly in the next big piece of this lecture here. So it comes in a variety of forms. Luckily, we got a startup lawyer on here who's seen all these forms and has drafted contracts for all these forms. And we'll go one by one through them. But in general, we're talking about 5 different ways that are typical. The ones on the left are the most typical. So something convertible to equity or equity. And then since we're talking about investing in Africa, debt is incredibly common in Africa, not common in the US. And so there's forms of debt. There's revenue-based stuff, which I have a whole other lecture on, but we'll touch upon that. And since this is part of the AVPA series, right, venture philanthropy, one of the up-and-coming ways to move money in the philanthropic capital space is with recoverable grants. We'll talk a brief bit about that as well. As we talk through here, we're going to use this one framework. We're going to use this picture over and over again in different forms. And so just to describe it while it's still blank here, we have on the vertical axis the revenues of the company. And so we're just assuming here that we have a nice steady curve, right? It's not some crazy hockey stick. It's just a nice steady exponential curve. We have a block of money that the investors have provided to the company. And that will always be the same size, in the same color, in the same spot in all of these diagrams. It's not supposed to be indicative of any specific size. It's just a block of capital you as investors provide to the company. And then we have time here on the horizontal axis. And so, investing starts at the beginning, right? There's some activities in the company before that, but here's the investment. And then something happens afterwards, and we'll fill in what that is, right? And we'll describe the different forms like that. And so, for example, here's what an equity investment looks like, right? Straight up equity. I'm going to buy a piece of the company, equity as in shares. It's not too much different from the blank one here. You hand over some money to the company, and they promise to pay you nothing, right? Just to make it clear here, this is all blank here, because in the agreement that you've signed as an investor, you got some shares. They gave you shares, but there's no other cash that they've promised to pay you. By the way, this is the most common way to invest in ultimately the most common way to invest in startups. Ultimately, what you're hoping for and aiming for and praying for is that someone else wants this company more than you, for more money than you paid for it, as soon as possible, but in realistic time frame, 5, 7, 10 years in the future. And when that new buyer comes along, whether that's an acquisition or an IPO, they're going to pay a price that is hopefully a lot more than you paid for the company, and therefore you'll get back more money than you put in. That's the hope. Realistically, more often than not, you get nothing. Right? More often than not, this dotted line turns into nothing more than hope, and you have your shares, and they're worthless at the end. But that's not why we invest. We invest because we have an expectation that this is a great company, and this company is going to grow, right? The revenues are going to grow. That's what we're showing here. And because the revenues are growing, the value grows, and you get more money back at the end. So for each one of these, I'm going to show you what the key terms are and dive into that. So when you're negotiating an equity investment, or when you're reviewing the terms for an equity investment, actually, I'm going to take a step back here for a second. When you're doing this as an angel, typically what happens is you're handed the terms, right? You're pitched a company in whatever form that comes in. We'll talk about that next week. And then at the end of that pitch, they tell you what the terms are and they tell you what the valuation is. They tell you, we're selling, shares at $1 a share, right? Or $1.50 a share or $8 a share, whatever the number is. And you know what the minimum investment is, because they'll tell you that too. Typically it's $25,000. That's almost always what the number is for minimums. And so you can do the calculation and see how many shares you're going to get, and you can do the calculation and see what percentage ownership that is. If you're leading a deal, if you're the first big investor in the deal, or if you're an angel group and you're leading a group, you might be able to negotiate that valuation. And I said I wasn't going to talk about it, but if you're running a fund, then you might negotiate that valuation. But as a standalone angel or a brand new angel, you're handed the terms. And so the terms you're going to look at when you're reviewing this term sheet is, what's the valuation of the company? How much is the company valued at before the money comes in? And then what are the other preferences on the deal? And I'm not going to go deep. That would be Angel Investing 301, to go deep on what all the preferences mean. But just keep in mind that preferences, as in your shares have certain rights that the founder shares don't. Most common preference would be simply you get your money back first. That would be called a liquidation preference. You want a board seat, right? You as the investing crowd, this whole round, we would call it, of investments, together you guys want a board seat on the company to protect your interests, right? That would be an example of preferences. And there's a whole long list, and we'll cover that when we get to 301 inside the program. So again, in terms of the interesting oddities of this particular style of investing, which again is really common, is you're not promised anything. You're not promised any payments, and you're not promised any schedule. You're not promised that there'll be an acquisition in 5 years or 7 years or 10 years or 15. Everybody talks about it as if it'll happen, because everybody talks about the success that's coming. But in terms of legal, actual promises, there's nothing in there.
Well, I would, other than what you said before, which is that it's true that typically there isn't, anything in the documents which requires a redemption of shares, or, sometimes, at the very early stages, it's also uncommon to see a registration rights provision or something like that. And so, in general, there's no sort of promises about future liquidity, although that's what everyone has in mind, right? Everyone has it in mind. Everyone likes the idea of it, and obviously that's what they're hoping for. And I do think one of the things about equity, and it comes up in the context of employee equity as well, or worker equity, whatever you want to call it, is, if you give people who are working for a company equity, they do over time start to have expectations about something happening with it. And there have been really good examples of like a long time ago in Seattle, we'll go back to like the late 90s, or maybe in the mid to late 90s. There's a very large company that had a very large workforce, software company, and for whatever reason they'd set all their stock options to expire at 7 years. And they twice filed S1s. In the old days, you had to file S1s publicly. Your first draft had to be a public filing, and they twice not been able to get out in the public markets. And then they had a bunch of options expiring, and they had basically a bunch of grumpy people who were working for the company because they felt like they hadn't really gotten what they expected. And so it does create expectations. That's what I would say. But you've said that before. But even if there's no strict language in the document which says one thing or another about getting anything back, it does create something in people's minds.
Yeah, and I'm not going to go and do the history lesson like I've done in the past ones formally here, but this is the way that corporations were funded at the beginning, right? The Dutch East India Company sold shares to the public. The British East India Company did the same. The South Sea Company did the same. That was the first bubble in the world. This is just the way that companies have been funded for 300 or 400 years. And the expectation in terms of size, how much growth is expected. When I go into the lecture of revenue-based, I'll harp on this a whole lot more, but the expectation in the room from most angel investors is that it will grow 10x or more. Like that you'll put in $25,000 and you expect to get $250,000 back, which if you're uninitiated to angel investing, sounds like a huge gain, sounds like an amazing thing. And the answer is yes, that is what the expectation is. And in real life, it happens less than 1 in 10 times. So in real life, you're not going to, You're going to think all of them are going to be 10x if you're an equity investor. And if you're lucky and do a good job, 1 out of 10 will be a 10x. So you'll get your money back from that one, and the rest of them won't. And even if you're a venture capital investor, you're probably not going to see more than one 10x out of every 10 investments. Most VC investors don't get that. Don't do that well. So what kind of company would come along where you would agree to these terms? Right? And I'm making them sound egregious, and they are, but it still is the most common form of investing. So I have done this, right? Despite my distaste for this style, I've done this style of investing because sometimes you just come across a company where it fits. So for example, Evernew. I met Evernew when I was teaching at that business school. I had a student walk in one day, beginning a class one year, and she said, my partner and I, we have a technology that makes cotton recyclable. We can take cotton, we can turn it back into fiber and spin it back into cloth and turn it back into clothing. And so here's a picture of a pair of Levi's jeans made by Levi's, and they're made out of old t-shirts. She took old t-shirts, she basically dissolved them and spun them back into fiber and fabric and whatnot, and then handed the fabric to Levi's. This is jean number 1 of recycled jeans. It would have been in the market this year, or last year, except for the pandemic. So you should be able to buy these later this year or early next year. They didn't have any revenue when I met her. They didn't have any revenue when she came through Fledge. She didn't have any revenue. It's been 6 years. I think she only had 1 year of revenue so far. But if this works, there will be more than a 10x return here. So this is the kind of investment where you want that giant return at the end. Another example over in Africa is Obama Stove. So this is Yusuf. He used to drive a taxi here in Seattle. He started this company while he was a taxi driver in Seattle. The company's in Ethiopia. I often describe he accidentally started the largest cook stove company in Ethiopia. At the time, it was the largest cook stove company in all of Africa. Now it's, I don't know, number 3 or so. They've made something like 600,000 of these stoves, 500,000 of these stoves. Cheapest stove in the country, cheapest stove of its quality in the continent. Right, so touched 2, 3, 4 million lives so far, depending on how you count lives. And because it's in Ethiopia, you're not allowed to take the dollars out of Ethiopia. There just is no other reasonable way to invest in Ethiopia. But this company has huge potential in front of them. There's 100 million people in Ethiopia. We could sell another 10 million stoves a year. So this is one where I did an equity investment.